We've currently reinvesting in a press for the automotive industry. There are big plans in terms of certain models being rolled out from South Africa, both for domestic consumption and for exports. So we're actually investing in our capacity on the automotive side. Construction is where you're seeing the softening, and of course steel is really a leading indicator for where the construction market's going. I think the general sentiment is that we are heading for some tough times. There's a softening in public infrastructure spend. And that's having an impact on steel outlook as well as on the construction outlook. So our approach really is, first in terms of these results, operationally they're very solid in this environment. And then we have McConnell Dowell that's in a more robust infrastructure market. And in the Pacific Rim, we're doing as much as we can operationally. You will have seen from the numbers, 264 million rand in continuous improvement and procurement savings. So organically, we are managing the business far better and also managing it for growth in these tough times.
The concern obviously comes in terms of visibility of earnings potential moving forward, and that the market's certainly worried about at this stage. I mean, many looking towards the mini budget in October for some direction in terms of government's infrastructure spend. But even if things are painted brighter there, and that brings in some optimism, I mean, there are question marks around delays in payment on the one hand and possibly delays in projects themselves down the line. So how are you positioning yourself within that space, specifically in the construction sector?
Our order book is stable year on year at about 31 billion rand, our two-year order book. Going forward, I think the next 12 to 18 months are going to be difficult before we see recovery. In fact, I may have mentioned this to you before. A few months ago, I was addressing some foreign investors and sharing my view that public sector infrastructure spend will return. South Africa needs it. The South African economy needs it. For social development, it's important. Job creation, it has to come back. And one investor got up and said he agreed with me, because if it doesn't come back, we're going to worry about far more serious matters than the Aveng share price. And I think that really puts it into perspective. So what we are doing is we are managing ourselves cross-sectorally for growth. We feel that because of our multidisciplinary capabilities, we will be able to compete in this tough environment. Our local Lennings operation, which is world-renowned for its track maintenance in rail, is working with McConnell Dowell, our Australian operation, to grow into the Australian rail market. So we're doing a number of things to manage this difficult period, largely in the South African market, because Australia and the Pacific Rim is a bit more vibrant than here.
Looking at your overall operating profit margin, we've got that sitting at 6.2% high. I mean, these are numbers that ordinarily sit in at a 5% level, so proving that you are doing well given the circumstance. The question is, how sustainable is that?
Yes. Construction South Africa margin is up almost double since 2008. Yes, it is driven by the big infrastructure World Cup related projects.
To what extent?
But in there, well, just to give you a feel, I've mentioned the procurement and continuous improvement. We've put in 264 million rand of savings across the group, of which about half is Grinica LTA. So operationally, getting that margin improvement, yes, there is the project-related profit taking, but also operationally we're doing things a whole lot better. Going forward, in terms of the sustainability of those margins, what we are trying to achieve is to improve operationally, but to improve into a softening market. So it is going to be tougher. If we can hold on to those margins, we'll be very happy.
Are we entering a phase where companies like Aveng are having to take on greater risk than before?
I think you know, it's a very important point that you're making, because our challenge is in these tight times not to take on huge projects at low margins, because when it turns, we want to have the capacity to ride that wave. So we're having to be very cautious on our risk profile and risk appetite in this environment. Currently, approximately 70% of our work in South Africa is private sector driven. The balance that we prefer is 50-50, which you see in Australia. So yes, I think the public sector will play a big role in seeing more big projects coming to market.
surely when it comes to that acquisitive side of things, you know, we're going to be looking at some kind of transforming deal for Aveng to use that kind of cash. I mean, what's your plans down that route? What kind of targets do you have in mind?
Yeah, look, I think firstly in these results, our board have agreed that we should, in terms of deploying that cash, maintain a dividend, which in these times I think is quite good for our shareholders at R1.45. But then also we are implementing an active share repurchase program of R1 billion, which will be value enhancing for our shareholders. We do have a good cash pile. In these times, we think it's important to have your cash in tight credit markets. If there are big projects, we can put bonding capacity behind it. And then turning to acquisitions, we are looking at a number of acquisitions. In the last 18 months, valuations haven't really been stable, given where markets have been. Things are settling down. You are starting to see some deal flow in the general market. For us, we've said power and water are areas that we want to get into in terms of extending ourselves in the value chain of those infrastructure categories. And so we are looking at those, and then in terms of our core businesses as well. So, you know, we've returned cash to our shareholders, and we've kept our powder dry for possible acquisitions. But the cash isn't burning a hole in our pocket. We're clearly being quite circumspect.
Resources companies starting to up their capex spend moving forward in anticipation of demand that's set to kick in. Are you beginning to see some of that flow through now on the mining side of your business?
Yes, well, the first to be hit by the downturn was our mining segments. In last year, we had 4.2 billion rands worth of cancellations, the bulk of which was in mining. As things have stabilized, certainly in the second 6 months of the last calendar year, we saw the cancellations halting. Now, in fact, we've won 4 new mining contracts, and certainly it is a vibrant area for us where we do.
And that across the continent?
Yes.
Perfect. In terms of outlook moving forward, business as a whole, because we've looked at it very sectorally at this stage, I mean, what's your outlook for the year that's upcoming?
Look, we'll continue to focus operationally on improving the way we do business. In South Africa, the market is soft. It is softening, and we are organizing our entire business to mitigate the domestic economic infrastructure downturn through growth initiatives on the rest of the continent, in the Middle East, Australia, and the Pacific Rim. And we feel that with our multidisciplinary teams and the way we are positioned, we should be able to compete in these difficult times. And then obviously the $64,000 question is, where's steel going? We are seeing an increase in global demand, so the trend is in the right direction.